John says, question, why is silver so depressed? It never moves. And that's, Ernie had a coaching session this afternoon with a gentleman who was asking a similar question, why his gold positions and his silver positions aren't performing as well as he hoped they were now this is the gold shares ETF, of course, but I want to take a look here in this case. And gold is extremely depressed. Let's take a look at SLV. I thought that was holding up better. Maybe I'm wrong. Yeah. It's all due to the monetary, my belief, and I could be vastly wrong on this. Anyone wants to correct me, go ahead and correct me. I didn't get a chance to see Ernie's write-up, but I wanted to see his thoughts on this because I was wondering, it's kind of the similar thing. I think this is due to monetary policy. The rates increasing and things of that nature, it's making the metals, the silver and gold that are related to the dollar, less. I'm pretty sure copper's still up, if I'm not mistaken. Titanium, I think, is still up as well. But the gold and silver related to monetary policy here and weakening of some global, not finances, but global money, I think, is causing the weakness in silver and in gold as well. And yes, everyone always says that silver and gold are the safe haven when the market's going down. This is more the Fed pulling money out of the market and the pandemic darlings completely collapsing under pressure and underweight, and people getting shaken out. Again, as I mentioned at the beginning of the presentation, that little image I had there, that those pandemic darling stocks essentially have given back all of their profits. They're trading at pre-COVID levels now. Most of them are trading a little bit below pre-COVID levels in the recovery. It's all gone. That probably shook out a lot of retail investing hands, but definitely shook out a lot of retail money that was in the market as well. So that is my thoughts. I don't know if I'm right, but that's what I think. It's related to fiscal policy and monetary policy and those kind of things, which is why they've been on a slide. But, you know, lumber's been coming off too, if you think about it. And I know that's not related to what you're talking about. Lumber is still extraordinarily high, but it did ease off of the extreme levels it was at when it was extremely difficult to come by over the summer, when the lumber prices were were at record highs, of course, because no one could get it anywhere. It's still relatively high, but it did have some easing, I think, in December and January before it came back up slightly. I haven't checked it recently. Let's take a look here. Lumber, I forget the symbol for it. No. What is it? Timber. I'm sorry, it's timber that I want, right? Not lumber. It's not the Timber Trust. I thought there was there it is. Wood. That would make a lot of sense, wouldn't it? So it's up today, 85. I thought it peaked out at, was it 120, 140? Let's go back. Oh, this is 1 year. No. It was 95 was the high. Yeah. So February, that's what it was. It came down. It was up high in the summer here. Let's go 2 years. But yeah, you can see in the summer, it wasn't, there we go. That's where it was. Yeah, that was the peak, and that was in April. Oh, it was exactly a year ago. Okay, it was exactly a year ago that it came down. But let's go back to 1 year. I'm sorry about that. Okay, there we go. So yeah, this has been doing its own thing, kind of following the market, but there's been an easing off, thankfully, of the timber and the lumber prices in this case. But it still gets pushed up whenever there's supply chain issues or other things, shipping issues as well in that case. So again, not any recommendations or suggestions, but when you run a search looking for those positions, again, and I say this, John, nothing against you personally, but the safe haven, of course, you know, we talk about is the safe haven in gold. What is that? What's that one? Not that one. Yeah, but using gold and silver as a safe haven for depressed markets where we're not seeing it now. What are we seeing that is forming the trend of something we'd probably want to use for a married put position, a standard collar position, a covered call position, even in the money hoping to get assigned, a bull put credit spread, or a naked put position? We're going to see the same stocks in each strategy with the basic criteria that I mentioned. And what are we talking about there? We're seeing energy, we're seeing shipping, we're seeing the larger capped position, large cap stocks again. And this was the picks of the day. I want to go back to that tip sheet OTM there. Yeah, so energy, Hess, energy, oil, those positions, you're going to see occasionally things come up as I mentioned, such as the dry bulk carriers and some of the bigger companies that withstood some of this as well. And because, I'm sorry, what you may want to consider, John, as a hedge, and let me see if I can find a presentation here real quick on that. There's a lot of them that you can find on YouTube, but if you want to consider a hedge right now in this market, and you're planning on using gold or silver or trades on gold and silver as a hedge, but they're going the wrong direction, they're going with the market down because of maybe monetary policy or other things that I mentioned, which I could be wrong on, just being a disclaimer here. Consider using an inverse ETF. SH, for example, goes opposite of SPY. Buy shares outright of SH. Possibly a volatility ETF. These are down today, of course, because the market's up. But shares of UVXY, VXX. I'm not at a point now where I'd say buy calls on the VIX, even though it's down 9% today with the market movement, because the volatility of the volatility index is still too high. So those calls are kind of expensive. And remember, or the VIX calls don't act like an underlying security. What I mean is you could be 5 points in the money on a VIX call and not have 5 points of intrinsic value. It doesn't work the same. It's based on the futures prices. And if those are different, you may have a call or a put on VIX that's 5 points in the money, but might only be trading at 450 or 460. It's strange that way, but it's hard to use a Black-Scholes pricing model to analyze what would my VIX options be worth, because it's not the same as a standard underlying position. It's not tabulated the same as an underlying ETF, stock, or even index for that matter. Is this a regular ARF? Okay, yeah, the ARC-F is up today, but I didn't see what ARC-K did. So a lot of times in a down market, here's another thing you could do, John. Check out this section here for ETF gainers and losers. Because when the market was going down, the biggest ETFs you'd see were probably the 2X or 3X Bear, QQQ, SPY, and other things. The Bear small cap, for example, it moves up as the market moves down. That's something to consider as a hedge. And these types of conditions right now, maybe other than gold or silver, which are not helping as a hedge and being depressed due to different reasons in that case. So that's a good alternative to consider is inverse ETFs, shares outright, or buy calls on the inverse ETF, or buy puts on the regular ETF, puts on SPY or QQQ, to act as a hedge against cash, even to protect, even if you pull out in cash, but to act as a hedge in that case with these market downturns, as opposed to using older standbys, although there are certain metals that are still showing strength in those cases. Okay. So, John, I know I didn't answer your question well, and I don't have the direct right answer. I will look into that for you. I'll find Ernie's thoughts that he had on that coaching session today. I believe it was his 4 o'clock coaching session, related to a similar question that came in from an investor about managing trades, covered call positions on the gold or SLV, I believe it was, because it's declining, excuse me, John, and as well, why is it declining when that's a common and old guard, old world hedge for the market, but we're not seeing that due to fiscal policy. And John, I promised you something here. You go to our YouTube channel, you won't see this. This is me logged in so I can customize or manage videos. You'll just see the subscribe button here, but go to YouTube, go to Power Options, and go to the search. And what I'd look for is the term hedge. Search across ours, and this one probably not so good. How you should hedge a portfolio. This one's a decent one to watch. It's Bear Put Debit as a market hedge. It's another approach that you can use, but we compare it to buying shares of a different ETF or an inverse ETF, or using the Bear Put Debit. I want to find, I think the Halloween one was one of the good ones. This one's pretty good. I'm sorry, hedging stocks directly versus a portfolio hedge. This one's probably better. Different options to hedge a portfolio. No, not that one. You know what? I'll look for some, but there's a good place to start. I think another term you could use. I'm not seeing the one I want. Let me try portfolio hedge, or maybe portfolio insurance. So some of these talk about direct married puts against the stock position, which is a preferred strategy that we use. Here's another one: trading UVXY or VIX for portfolio insurance. So what I'll do, John, is I'm going to go through to find some of my better ones. I want to find one of the ones where we talk about and compare shares of inverse ETFs, buying puts directly on SPY, buying calls on the inverse ETFs. There's one in here somewhere from a year or two ago, somewhere in that time frame. I'll get that to you and send you the email. So let me jot down my note, John. But that one under hedge, that bear put one is a good discussion to look at. Let me try that again. Hedge. And the reason why I say that, this was brought in by Octavio, and he wanted a cheaper way to use a hedge on his total portfolio for a market downturn. So rather than just buying a put on SPY, he considered a bear put debit hedge. My initial thought on that was I was concerned because, as we know, using a bear put debit spread, let's go to custom spreads here. Let's go to SPY. And let's go out to June. 17th, that's standard. Okay, I want to do two things here. Let's just say I'm worried about further declines now that we've gone back above 400. Not a recommendation or suggestion. Let's say I buy 2 or 3 contracts, John, of the 405 put to hedge my total portfolio, which is heavy in the S&P 500. Okay, so let's buy 5. Okay, it's going to be fairly expensive. It's $15.69. $7,000 to hedge the portfolio. And of course, apologies, John. If the stock, of course, if the market, of course, goes down to 380, I'm going to have a profit about $12,000 to help hedge my portfolio. That's not that it's going to be valued at $12,000. That's $12,000 profit on the 7,800 I invested. Why am I not buying 100 shares? Well, I want to hedge part of my portfolio. Long story short, this is the 405. What Octavio's approach is saying, hey, I don't want to pay the full $15 for 5 contracts. I want to kind of hedge this. So why don't I do this as a bear put debit spread and sell a lower strike put so my cost is reduced? Okay, so selling the 400 now at 13. So now the cost is only $2 or $1,100 for 5 contracts instead of 7,000. Well, see, now here's the problem. Well, what I was concerned about, the problem is if the decline exceeds my expectations and drops down to 3,800, I'm only getting 1,300 back. Didn't leave that downside open with the hedge. It's a capped hedge. If the market only fell 5-6% from where it is right now, this might still be okay. Not exactly. It would be a little bit, we'd be better off with the long put in that case, even though it was more expensive. But that webinar there, excuse me, bear put debit is a market hedge. It's a good one to watch because we discussed the other ways to hedge. Bear put debit spread on SPX, and we talk about the other ones there as well that could be used. And then, of course, you can see we start comparing them on a table as to how they perform. So that's one that you could do. This one is pretty good. It's more open, but it's longer. And we go through a variety of different ways to hedge your portfolio. That might be too much. I think I want to keep it straight and focused and just on the concepts of some of the other alternatives you can use rather than gold and silver as a market hedge if you feel the market is still going to continue down. In that case, take a look at some of those inverse ETFs. Take a look at maybe shares of UVXY or VXX.